Good afternoon. Welcome to the Heritage Foundation, our Douglas and Sarah Allison Auditorium. We, of course, welcome those who join us on our heritage.org website on all of these occasions. For our guests here in-house, we would ask that you make that last courtesy check that our mobile devices have been silenced or turned off. And for those watching online, we remind you that you can always send questions or comments at any time simply emailing speaker@heritage.org. And of course, we will post the program on the Heritage homepage following today's presentations for your future reference. Leading our discussion today is Dr. Norbert Michel. Dr. Michel is Research Fellow in Financial Regulations in our Thomas A. Rowe Institute for Economic Policy Studies. He writes about financial markets, monetary policy, including reform of Fannie Mae and Freddie Mac, as well as focusing on that famous too big to fail problem. Before joining Heritage in 2013, Dr. Michel was a tenured professor at Nicholls State University's College of Business, teaching finance, economics, and statistics. Please join me in welcoming Norbert Michel. Norbert.
Thank you, John. So I'm just going to introduce our panel, and we'll get going. We have Congressman Hill coming, I believe, at around 2:25 or 2:30. They called for votes in the House, so he can't be here to do the keynote to start with. So we're just going to kind of play things by ear. So to my immediate left, we have David Burton, who's a senior fellow in economic policy here at the Heritage Foundation. David focuses on securities law, entrepreneurship, financial privacy, regulatory and administrative law issues.
Truth, justice, in the American way.
And tax policy. I don't know about the truth part with David, but David was general counsel at the National Small Business Association for 2 years before joining Heritage in 2013. And before that, he was chief financial officer and general counsel of the startup Alliance for Retirement Prosperity, a conservative alternative to the AARP. For 15 years before that, David was a partner in the Argus Group. It's a Virginia-based law, public policy, and government relations firm. And his career in financial and tax matters also includes, among other things, the post of vice president for finance and general counsel of the New England Machinery, which was a multinational manufacturer of packaging equipment and testing instruments. David's law degree is from the University of Maryland, and he holds a Bachelor of Arts degree in econ from the University of Chicago. And then next we have Diane Katz, who is a senior research fellow for regulatory policy, also here at Heritage. Diane's analyzed and written on public policy issues for more than 2 decades. She's also a veteran journalist. Previously, she was Director of Risk, Environment, and Energy Policy for 3 years at the Fraser Institute, which is an independent policy research and educational organization in Canada. And from 2002 to 2008, she was Director of Science, Environment, and Technology Policy for the Mackinac Center for Public Policy, which is in Midland, Michigan, and is actually farther north than some parts of Canada. Diane was a member of the editorial board for the Detroit News for 9 years as well, and she specialized about writing in science and the environment, telecom, and technology, as well as the auto industry. And she's won many awards there, including top honors from the Michigan Press Association in 1994, 1996, 97, and 98. Diane holds a bachelor's degree in philosophy from Thomas Jefferson College and a master's degree in journalism from the University of Michigan, which is Ann Arbor, Michigan, and the best college football uniform pretty much ever. And we also have Brian Knight sitting next to her, and this is completely in order by accident, by the way. Brian most recently worked for the Milken Institute, but now he is a senior research fellow for Financial Markets Working Group at Mercatus, or at the Mercatus Center at George Mason University. Prior to his stint there and at Milken, Brian worked for a broker-dealer with a focus on emerging online private placement market and was the co-founder of CrowdCheck, a company providing due diligence and disclosure services to firms engaged in online private offerings. And Brian also served as an attorney for the federal government and now researches the interplay between regulatory policy, technological and market innovation, and how best to improve access to capital for businesses of all sizes. Brian's law degree is from the University of Virginia, and his bachelor's is from the College of William and Mary. Next to Brian, we have Thea Brooke Knight, who is the Associate Director of Financial Regulation Studies at Cato. Thea is an attorney with extensive experience in securities regulation, small business capital access, and capital markets. Before joining Cato, she co-founded and served as general counsel of CrowdCheck, the company providing due diligence and disclosure services. It's really back-to-back like that. I've never done that. Following the recent financial crisis, Thea served as an investigative counsel for the Congressional Oversight Panel charged with overseeing the expenditure of the Troubled Asset Relief Program, also known as TARP. She also spent several years with the Washington office of the law firm Wilmer Hale, where her practice focused on securities litigation, securities enforcement defense, and corporate investigations. Thea's BA is from Middlebury College, which is in Connecticut? Vermont. I'm not good on the Northeast. And her JD is from the University of Michigan Law School. More Michigan. Last but not least, we have George Selgin. George is a senior fellow and the director of the Center for Monetary and Financial Alternatives at the Cato Institute. George is also professor emeritus of econ at the University of Georgia, and his research covers a broad range of topics within the field of monetary economics, including monetary history, macroeconomic theory, and the history of monetary thought. He's the author of several books, including The Theory of Free Banking, Bank Deregulation and Monetary Order, Less Than Zero, The Case for a Falling Price Level in a Growing Economy, which is still my favorite. And most recently, Good Money, Birmingham Button Makers, The Royal Mint, and the Beginnings of Modern Coinage. George is one of the founders, along with Kevin Dowd and Larry White, of the Modern Free Banking School, which draws its inspiration from the writings of F.A. Hayek on denationalization of money and choice in currency. And I think, he has too many scholarly journal articles to count. He's been with Cato since 2014. He holds a BA in economics and zoology from Drew University, and his PhD is from the New York University. So I want to thank all of you guys for being here and for contributing to the book and still talking to me after we were done. While I'm thanking people, I'm going to thank all of the authors. There are actually a couple of the other authors here in the audience who we couldn't fit on the panel. Otherwise, it's a thankless task. And I do want to mention a few other names, people whose name you won't see on the book, but were a tremendous help in getting it out and getting it done on time. And without them, those things just wouldn't have happened. Just really quickly, that list is Therese Pennefather, Karina Rollins, John Fleming, Melissa Bluey, Jay Simon, Caitlin Thompson, Rob Coleman, Matt Buckham, Lydia Mashburn, and Melanie Aycock. Thank all of those people very much. You learn how much goes into putting one of these things together when you do these, so had no idea.
I had to overcome many obstacles, including Norbert.
You beat me to it. I'm going to start off with just sort of the two broad themes that are pretty much run through almost every chapter of this book, and then we'll get the panel discussion started. Those two themes are increasing levels of regulation paired with increasing levels of government backing. Now, this is a toxic combination that leads to more financial risk in the system, not less. And that's reflected nicely in these two charts that are behind us. They trend in the opposite direction, and that's no accident. That's generally not too surprising to people, but what does tend to surprise people of a general audience is that increasing levels of regulation, along with the increased government backing, have actually been the norm in financial markets for a very long time, especially the regulatory side. And it's surprising because it doesn't fit the narrative coming out of the 2008 crisis at all. After that crash, that was the story. That's what won the day. that deregulated financial markets caused that crisis. And the truth is that that's a false narrative. Those markets, even the non-banking sector, were heavily regulated prior to the crisis. These graphs we have right now behind us exemplify these long-term trends. As regulation increased in both size and scope, firms took on more risk, partly because doing so was blessed by the federal government, whether it be expressly blessed by the regulators or simply backed implicitly. Long before the crisis, throughout U.S. financial markets, we've had many federal policies that increasingly force taxpayers to back the possibility of a private financial loss. And this combination is not free enterprise. It just isn't. It's also destined to end poorly for many Americans, and it has on a number of occasions. Only most recently in the 2008 crisis did we see it. Yet somehow, politicians were able to sell people on the idea that free markets broke down, causing the 2008 crash, and that's wrong. So we've put 2 edited volumes together here at Heritage during the last year to sort of help dispel that myth, and these 2 books together complement each other nicely. The first one, and we can get more copies of either, the first one was this one, which is the case against Dodd-Frank, and the second one is what we're launching today, which is Prosperity Unleashed, Smarter Financial Regulation. The first book is a title-by-title takedown of Dodd-Frank, and it's exclusively focused on Dodd-Frank. The second one obviously is broader than that, but you do get a sense in the first book of how Dodd-Frank did not end too big to fail, how it failed to adequately address the problems that caused the crisis, and how it forced even more micromanaging and government mandates on markets. And that case is very easy to make, but what seems to get lost in that debate, again, is that that was really more of the same. In other words, Dodd-Frank was more of the same, more regulation. We didn't have deregulation, so we got more top-down control, more government involvement, and more taxpayer backing. Dodd-Frank was an expansion of these policies. And we've shifted from what I call the banks are special doctrine to now financial companies. All financial companies are special. In other words, if you go further back through history, you had this sort of banks are special idea where we couldn't let banks fail because those were special kinds of companies. And that's been broadened now quite a bit to basically any kind of financial company or any so-called systemically important financial company. And of course, the regulators get to make up who those are as we go along. This is, I think, the biggest danger that we face now. And this shift, along with dispelling this myth, are the main 2 motivating factors in us putting these books together. The problems in our regulatory framework span all segments of finance now, both banking and non-banking. And aside from the obvious problems, we have problems in administrative law, civil and criminal liability, the structure of our regulatory agencies, the amount of resources spent on general regulation that never seem to show any benefit, the varied amount of preferences to special groups at the expense of others, and a whole host of social policies being injected directly into financial markets that distort credit markets. All of these problems retard the flow of capital to its most productive use and therefore harm the broader economy. So this book that we have now has 23 chapters from over 21 contributing authors, and together what you basically have is the replacement framework for Dodd-Frank. There are countless reform proposals in these books, and along with our recently released book from our friends at Mercatus, Reframing Financial Regulation, nobody can argue that conservatives do not have an alternative set of proposals to reframe and fix financial markets. So with all that, I want to get our conversation started by focusing on one of Diane Katz's 2 chapters in the book, and that one chapter is titled The Massive Federal Credit Racket. So Diane, What exactly are we talking about there in that chapter?
Well, most people are aware that our debt is approaching 20 trillion or so, but they may not be aware that there's another $18 trillion in what I call debt exposure from loans, loan guarantees, and subsidized insurance that are lavished out by some 150 federal programs. And by exposure, I mean it's the potential loss from these outstanding loans and loan guarantees. These trillions of dollars represent the commandeering of financial services by the federal government and its escalating power over private enterprise. Regulators, whether it's via Dodd-Frank or the regulations that existed prior to Dodd-Frank, have long scrutinized banks and bank holding companies, but there's virtually little oversight of these credit programs. And that's why double-digit default rates are not a surprise. The credit portfolio consists of direct loans and loan guarantees for housing, agriculture, energy, education, transportation, infrastructure, exporting, and small business, among others. The insurance programs cover bank and credit union deposits, pensions, flood damage, crop prices, and terrorism. And then of course, we have the capital for mortgage lending through Fannie Mae and Freddie Mac. This is astonishing to me, but the researchers with the Federal Reserve Bank of Richmond calculate a bailout barometer, and they've estimated that 61% of all financial liabilities in the U.S. are either explicitly or implicitly backed by taxpayers. The actual liability, I think, is probably greater because the federal accounting methods don't reflect the true costs and the actual subsidies that all of these financing programs impose. With some of these loans extending 40 years, what we're doing is we are imposing our debt on future generations without their consent. And it's a guarantee to be an anchor on future economic growth. You know, this kind of financing is entirely detached from the profit motive. And that means that there's very little discipline, inherent discipline. Tax revenues, of course, are provided by, are an endless source of the capital, and the bureaucrats are largely protected from accountability. Losses are dispersed among millions of people, and they're considered to be justified as a cost of reducing purported access inequities to capital. Of course, there's this idea that if you're not getting capital, that somehow that's because you deserve it and somebody's being mean to you, as opposed to the idea that perhaps they think you're not going to pay it back. What a concept, right? When the government shifts risk to taxpayers, borrowers are largely relieved of the consequences of their failure, and they act accordingly. When borrowers don't compete for private loans based on merit, productivity improvements and innovation become less important than political capital does. And creditworthiness also becomes less relevant to banks who are, in some respects, happy to sit back and cash in on fees as they act as pass-throughs for federal financing. So what we end up with is a larger proportion of the U.S.'s economic assets that are inherently weaker than they would otherwise be if they were financed on the private market. One thing I do want to point out, in particular with respect to regulation, is that a lot of this financing creates a regulatory chain reaction, because when the government engages in lending, what had been private property becomes essentially public property. That's what happened, for example, with deposit insurance. When government in 1933 began to back deposits, it also, at the same time, meant that they could dictate how those deposits were treated by the banks. And these $18 trillion worth of financing and credit, imagine what that has wrought in terms of the regulatory burden across the board in the U.S. So I just wanted to bring that to your attention, and that this is an area where there has been little attention paid, but that certainly is, ripe for dramatic reforms. Basically, we should be cutting this off. Thank you.
Thanks, Diane. And Diane's chapter is a list, a partial list of about 150 programs. There's a pretty full list in the appendix. Those are explicit, intrusive, direct types of federal backing. So I want to switch up a little bit and go to George. George's chapter is on the Federal Reserve, and principally it deals with the Fed's emergency lending versus its normal operations. And George, when we hear this all the time, that the Fed's not really intrusive in the same way with this sort of backing, because it's only doing these things in emergency times. So I'll just throw it over to you with that, and if you want to just explain a little bit about what your main proposal is.
Well,
if you would.
The central banks today have two functions. Can everybody hear me okay? They have the monetary control responsibility. I'm setting supervision aside, by the way, though, of course, it's an important topic in this book and in general. They're responsible for monetary control, which is for controlling, managing the total amount of liquidity in the economy. And they're lenders of last resort, which is to say they're supposed to be relied upon by struggling financial firms in times of crisis as sources of liquidity when the private marketplace itself isn't adequately allocating liquidity to firms that may be solvent but illiquid. The second function is actually older than the first, because the lender of last resort idea came up in the days of the gold standard, when monetary control, strictly speaking, was simply a matter of letting the gold standard do its thing. So the only function of the first central banks, like the Bank of England back in the 1870s, was this lender of last resort function. Well, basically, the argument in my chapter is that there's no longer any rationale for a distinct lender of last resort function. That if central banks today, like the Fed, simply see to it that there's enough aggregate liquidity in the economy, in principle, doing that should be all it takes to keep the economy liquid in normal times as well as during crisis times. Because we now have very well developed secondary markets such that those markets should be able to see to it that the aggregate liquidity that central banks provide and are supposed to provide in sufficient amounts gets allocated to the solvent firms in the economy, particularly those that are struggling with liquidity and so are willing to pay a price for it. Now, what does this mean in practice? In practice, it means that you shouldn't have to have any distinct last resort lending facilities. At the Fed, for example, and this is not unlike the arrangements of other central banks traditionally, you have the monetary control arrangements, which traditionally, again, were handled through, consisted of open market operations where the central bank would buy securities, usually treasury, short-run treasury securities, from a limited set of primary dealers, and those dealers would see to it that the liquidity created thereby got into the economy through various private channels. Separately, you had the Federal Reserve's discount facilities, consisting of the discount windows of the various Federal Reserve banks. And those were there to serve the lender of last resort function, where banks struggling for liquidity that couldn't obtain it in the private marketplace could approach the discount window for direct loans according to preset conditions that those discount facilities had to abide by. All right. Well, In principle, there's no reason for a separate discount facility, and there were those who argued back in the 90s that we could just rely on the Fed to create adequate liquidity through its open market operations and let the private market, including the market for interbank loans, get the liquidity to the places most needed. What happened during the financial crisis actually superficially seems to suggest you do need a discount window, but upon close inspection actually supports the argument that you don't. And what happened was that the primary dealers themselves were going belly up. Some of them did go belly up. The general problem of the general reliance on those dealers as conduits for emergency funds to get to the rest of the marketplace broke down. And the Fed ended up creating all sorts of emergency lending facilities in order to provide last resort funds to various markets and to various particular financial institutions. But if you stand back from what was happening here, it turns out that the real problem was the reliance on a limited set of dealers, the primary dealer system, and on a limited set of securities for open market operations. What I propose is that, and by the way, at the same time, the discount window ended up doing nothing. In fact, the discount facility has been moribund since the crisis, and that's true also in England. If you look at the statistics, you'll see no one's borrowing from the discount window. Nobody has for years, and the same's true at other central banks like the Bank of England. All right, so what's the solution I propose for providing emergency liquidity? It's simply that we do away with emergency lending altogether, but change the way in which the Fed conducts open market operations by having it do two things differently. First, instead of just dealing with a limited number of primary dealers, it still deals with about a score of primary dealers, though different ones than before the crisis. It should deal with any bank, at least any bank that's considered solvent, that has a high CAMEL rating, rather, which is a rating of riskiness that federal authorities rely on for other purposes. And that would mean access to all banks and possibly to money market funds and some other firms that are presently dealing with the Fed in its various operations. They could all engage in the auctions by which the Fed supplies general liquidity to the marketplace. So, by the way, there's precedence for everything I propose. The European system, for example, has the ECB dealing with hundreds of counterparties, not a dozen or 20 like here. So that's the first component of the reform. When there are open market operations, everyone can bid with the Fed, or most financial institutions can bid directly in these open market sales of liquidity. And so they don't have to rely on a limited set of privileged primary dealers to approach or to get funds from indirectly. Second, the auctions, instead of just being limited to Treasury securities, should be auctions of liquidity for a variety of assets. For example, all the assets that have traditionally been accepted as discount window loan collateral. And the way you can make the auctions work for these different assets has itself been employed now for some years at the Bank of England. There's something called a multi-product product mix auction, where you actually have firms submitting bids for liquidity for federal funds with different kinds of assets where they have different prices for the different assets, and this auction mechanism allows the funds to go to whoever makes the best offer, conditional on the quality of the asset, where the pricing involves a haircut for certain more risky assets. Okay, the bottom line is, because I know I don't want to talk, I've already talked a lot, if you put that mechanism in place, you don't need a discount facility, you don't need anything. The Fed just does one thing. It sees to it that there's enough, that its open market operations provide enough aggregate liquidity for monetary control purposes to achieve whatever its general macro targets are, whether it's an intermediate interest rate target or long-run price stability or employment target. Now, the only thing that changes is, under some circumstances, you'll have firms bidding for liquidity that normally wouldn't take part in the auctions because they're hard up for it because things are bad. But they're solvent and they can bid competitively. The other thing that happens is in certain times they bid successfully with securities that normally the Fed wouldn't be acquiring. But the market determines who gets the funds through a competitive bidding process. There's no direct lending, there's no allocation of the credit by the Fed, and most of the time it's just buying Treasury bills and dealing with a small set of counterparties, as has been traditionally the case. In emergency situations, when markets are stressed, automatically you have a broadening of the kinds of persons, of counterparties approaching the Fed for credit and the kinds of securities that the Fed ends up buying. But the Fed doesn't even have to think about it. The auction itself sees to it that the funds go where they're needed. This is a much simpler approach, and I think it would solve a lot of problems. I hope that wasn't too long.
No. Thank you, George. The whole point there is essentially you get out of the direct lending business, which typically ends up being some form of bailout. So
That's right.
Congressman Hill, French Hill from Arkansas, has agreed to join us, and today's a bit crazy over there as well as here, so we're doing things a little bit out of order. But if you would, please help me welcome the whip for the House Financial Services Committee, Congressman French Hill.
Good afternoon, everybody. Happy to be here. To say that it's crazy over at Capitol Hill is not a distinguishing characteristic, though. It's like that every day. Well, first, let me commend Heritage for putting on this panel and having the experts share these ideas with you. And let me thank Norbert and David and other scholars who've put out Prosperity Unleashed, an excellent topic, a great compendium of some of the best ideas that we all need to consider legislatively and regulatorily. I want to set the stage before I talk a little bit about the actions of the committee and how we might address some of these good ideas. Just to remind all of us that this past 92-month expansion is the slowest since World War II. And I was real intrigued to hear your monetary policy ideas, because as a former banker of 35 years, it's intriguing to me to see us have $2 trillion now in excess reserves out there in our economy, interest rates effectively at zero, a money multiplier at about 3.7. The last time it was that low was when Eccles was chairman of the Fed in the 1930s. And when you look at $2 trillion of excess reserves, you have to ask yourself, well, what were the reserves prior to the crisis? And for the 10-year average prior to the summer of '07, we had excess reserves of about 1.7 billion with a B out in the economy. And today we have some 2 trillion with a T. And that just tells you we are in uncharted, unprecedented territory in monetary policy. And while we're talking mostly about regulatory policy now, I think nothing affects the economy more than the next few years and how the Fed deals with its monetary policy challenges. And I appreciated my friend's comments on that. The other thing on that macro approach, which I think affected the political outcome in November, and certainly those of us in the House who are out and about on a regular basis noted, was the fact that the economy, as I said, for 92 months has been moribund. It's been below average. But how does that manifest itself out in the real economy that small business people face, community bankers face? And it's this issue of NFL cities. NFL cities. Most of this job growth that we've experienced on the rebound since the Bureau declared the recession over in the spring of '09 have accounted in just 20 counties in the country. So 20 counties in America account for over 50% of the job formation in this long, slow recovery. And all of those 20 counties are an NFL franchise, with the exception of Austin, Texas. So that, again, is such a structural burden that we have to address as policymakers to make sure that we're doing some things in the right way. When you combine with that on the capital formation front, that we've lost about 50% of our public companies over the last 2 decades, and that we don't seem to have our cost market value structure in place to encourage our young businesses to go public and sustain a public offering. On the banking front, we all know that we've only had, during the course of the last 6 years, about 3 charters successfully granted since Dodd-Frank was passed. The good news is that in recent months, not unlike the rally in the stock market, there have been 8 applications submitted to become new banks in our country. And maybe there's a rebound in the animal spirits that will transpire as a result of the change in the national election in November. Maybe that'll translate into a higher multiplier rate for those $2 trillion of reserves. Maybe we'll see more applications. Maybe we'll actually see some public offerings. But in my view, we won't unless we get this regulatory policy situation squared away. And so that's why I'm grateful for the work by Norbert and all the authors of these fine articles in Prosperity Unleashed. On the House Financial Services Committee, this is kind of the heart of what we do. We want to have an effective public policy mission that leads the way on Capitol Hill, not only to benefit bank formations and survival of community banking, make sure that people can get access to the credit that they deserve, but also that in the small broker-dealer arena as well. So not just focus on community financial institutions as defined as commercial banks, but also talk about making sure that out in the dealer community across the country, we also are seeing people do capital disintermediation and formation by virtue of entrepreneurship in the broker-dealer arena. And in that regard, we hope to mark up here in the next few weeks the Financial Choice Act 2.0. I can certainly tell you on behalf of Chairman Hensarling, all ideas are welcome until the date you see announced scheduled for a markup. So members are still consulting with people about how our draft legislation that we introduced last fall can be improved when we introduce it this spring and mark it up. And I can tell you that is the core of what we'll do on the financial regulatory front for, in my view, around banking here in the first few weeks of this Congress. The Choice Act, I think everybody knows well, offers a concept that I defended at CPAC on Friday with my friend Tom Honig from the FDIC, which is an off-ramp for commercial banks that have a 10% Tier 1 leverage capital ratio, that they get relief by definition from Basel III, from the conditions of Dodd-Frank, from Volcker. And it's a way to say to traditional financial institutions that want to raise their Tier 1 leverage ratio to 10%, this is a way that you have an off-ramp from this legislative overreach that we've experienced under Dodd-Frank. And I call it an overreach because you've got to combine all the regulatory base that we have through our state and federal regulatory system and then overlay Dodd-Frank and Basel III on top of that. You can't look at it at the margin. You have to look at it in aggregate. And that's why I think it's been so pernicious, particularly for small asset institutions that just cannot amortize this avalanche of costs across their earning asset base. The other thing that the Choice Act tackles is this issue of institutionalized too big to fail, which many policymakers, particularly Republicans in the House, believe was memorialized by the approach in Dodd-Frank. And we want to go a different direction. And so Title II takes a different approach by a special bankruptcy chapter for large, complex financial institutions. It tackles the issue of what to do about the CFPB, its structure, its constitutionality, its authorities. And there are many issues about that in Washington today, many different approaches. But I think you'll see a consensus approach take place in the Choice Act when it's introduced. I think that is an area where ideas and suggestions are still welcome over at the committee. And then this issue on asset classes and risk retention. Again, we put a lot of emphasis on commercial banks, portfolio lending, but a big part of our economy is financed not by portfolio lending. It's financed through other means, and one of those means is the mortgage-backed securities market, particularly for commercial risks as opposed to residential risks, which were at the heart of the crisis in '08. And I think the Choice Act effectively deals with commercial mortgage asset classes in the bill that I think will aid capital flowing back to non-NFL city mortgages. If you're in an NFL city and you have a low loan-to-value property, then probably a life company will make you a permanent first mortgage on that property. But for the rest of us, that Bank America building in Greenville, Spartanburg, or that AT&T building down in Jackson, Mississippi, or in Little Rock, Arkansas, is likely to be financed by a commercial mortgage-backed security. And we want to make sure capital flows there because so many of those securities were issued in the '05, '06, '07 timeframe, and they're up now on renewal since so many typically have a 10-year maturity. I'll touch on the rest of the committee's agenda beyond choice. We have to reauthorize the flood program, which is coming up, expiring in September. That's an issue where the committee's done a lot of work over the last couple of years. How do you bring free market discipline to that marketplace? That's the question. And that will be a key issue this year. I'm pleased to see that we have a Treasury Secretary confirmed who professes interest in engaging on GSE reform. As Norbert and David know, I've been interested in GSE reform since 1983, well beyond the birth date of many in this room. And we have not met the test since those days. We have not answered the call. How do you have a vibrant secondary mortgage market, but do it in a way that's fair to taxpayers and effective? And we've never answered it. We didn't answer it in the 1980s when Fannie Mae's former CEO described it as the largest crap game in the world. We didn't answer it in the early 90s when capital standards were put in place for GSEs, but no other reforms. And we sure didn't answer it in the 2000s when our mortgage market came sort of tumbling down. All at the heart of that was activity at our GSEs. So I'm glad to see we've got a Treasury Secretary who's going to prioritize that. Other issues important to the committee, I think you'll see us address, looking at Sarbanes-Oxley at 15 years, looking at the Jobs Acts at 5, look at market structure, look at corporate disclosure and governance issues, taking a look at FINRA and the future of FINRA and what's the best course of action there. And then just generally, something that everybody here has been so helpful on, barriers to capital formation. How do we remove those barriers? How do we lower those costs? How do we lower the sustainable costs associated with capital formation? Because we don't want to go on the same track we've had. We've had a blip, positive blip from Jobs Act IPOs. That's great. How do we sustain that? How do we make it more robust? But the fundamental issue is it's against the backdrop of 50% drop in listed companies in this country and a backdrop of ever-increasing quarterly compliance costs to be public, raising, again, the market value necessary to go public, pushing it way up towards, in my view, $1 billion. And that is not a way to encourage entrepreneurs to seek capital from the public markets and expand their businesses in that way. So my hat's off to your work. I'm grateful for Heritage's consistent leadership in this arena, and certainly this member of Congress values this document very, very much, and appreciate the chance to work with you in the coming weeks and months ahead on Capitol Hill. And thanks for inviting me today. Appreciate it. Appreciate you. Thanks.
Thank you very much, Congressman. And we'll just kind of shift gears now, and I'll segue off of one of the terms that he used there, which was barriers to capital formation. David's chapter, as well as Brian's chapter, from sort of a different perspective, deal with those barriers. Barriers to entrepreneurs, small businesses, people who want to start both financial and non-financial types of companies. So because his office is next to mine, and he'll be mean to me if I don't, we'll start with Burton. And David, what sort of landscape are we looking at, and specific reforms should we be looking for in the entrepreneurial access to capital arena?
Thanks, Norbert. There's a number of chapters in the book that address this subject from one perspective or another. Brian's going to talk a little bit about it from his perspective. I wrote a book chapter on entrepreneurial capital formation. Dan Gallagher wrote a chapter on improving secondary markets for smaller public companies and regulated companies, and to some extent the private capital markets. Rutherford Campbell wrote a book on blue sky laws, which are state securities laws, and specifically how they can be preempted by federal law to improve primary and secondary markets for entrepreneurs. Some of you may not know that Exxon or other companies traded on national exchanges only have to deal with the federal regime because they're, quote, covered securities. But if you're a smaller company, you get to deal with the federal regime, 50 state regimes, the District of Columbia regime, and then introduces a tremendous amount of expense and delay for smaller companies that larger companies don't have to deal with. And Campbell, by the way, is a University of Kentucky law professor, has written a number of really fine law review articles over the years, the Wreck of Regulation D, Regulation A, Search for Moderate Capital, and 3 or 4 articles, including this one on blue sky. My chapter on entrepreneurial capital formation addresses a wide variety of issues because, alas, there are a wide variety of issues, a wide variety of impediments to entrepreneurial capital formation. Regulation D is the primary way that private capital is raised in this country today, about $1.4 trillion annually. It's a larger market than the public capital market in terms of initial raises every year. Yet there hasn't been a lot of focus on how to improve it. Former Congressman Garrett had a Private Placement Improvement Act that would have done a number of things, including basically roll back 2 SEC proposed rules that would make Regulation D significantly worse. There's also Congressman Schweikert, who has a proposal to broaden the definition of what counts as a sophisticated investor under Regulation D, and would set the statutory threshold for accredited investors at their current levels indexed for inflation going forward. Regulation D offerings are generally only available to accredited investors. That would be individuals with an income of $300,000 or more, or net worth, residents exclusive of $1 million or more. In other words, relatively rich people. And that's something like 7 to 9% of the American people who can invest in these offerings. Others cannot. And a lot of us think that should be democratized and allow these ordinary Americans to invest in these higher risk but also significantly higher return private offerings. Regulation A, sometimes called mini IPOs, has been substantially improved by virtue of what was forced on the SEC by the Jobs Act, but there's still a lot of room for improvement. Regulation crowdfunding, I think, is a very useful examination of how Congress and the SEC can screw up a good idea. You take an original statute by Congressman McHenry that put on a Word document, I think would have fit on 1 page. It was 3 pages in the bill. Then by the time the House got done with it, it was about 12 or 14 pages. By the time the Senate got done with it with their amendment, it was about 30 pages. And by the time the SEC got done writing the rule, it was 600 pages. These are meant for the smallest firms in America. You cannot raise more than $1 million using Regulation CF for crowdfunding. So there's a need to rethink that. I address a number of ways to do that in the book chapter. I also think that that is very much in play with Congressman McHenry offering the Fixed Crowdfunding Act last year, and a revised, somewhat more aggressive version of it is likely to come this year. We have a number of other issues. Finders, you might be surprised to know that if your Main Street business colleague tells you, I'll pay you 2% if you introduce me to a rich guy that invests in my company, that the SEC thinks that you should be registered under the same rules that govern Merrill Lynch. I think that's sort of ridiculous, but we've been in Never Never Land on that for 16 years. There's a need to fix that so that small business colleagues can help each other. Disclosure reform, Regulation SK, Regulation SX, all the rules governing these massively thick reports that public companies have to put out. That needs to be rethought, rationalized. We have a very irrational disclosure regime that goes up and down sort of for neither here nor there kind of reasons with respect to public companies, but also Reg D companies, Reg A companies, crowdfunding companies. There's a need to lighten the load and also to rationalize the disclosure regime. As Troy Paredes wrote in a law review article called Blinded by the Light, you can basically get to the point where there's so much information disclosure that it obfuscates rather than informs. Let's see. And the last thing I guess I thought I'd mention is Norbert and I wrote a chapter called Financial Privacy in a Free Society, which looks at the AML rules, Know Your Customer rules, the BSA rules, and all that foolishness. The long and the short of it is those rules have become ever increasingly burdensome now for 3 decades. There hasn't been any serious attempt to look at the benefits of them nor the costs. It's just sort of assumed that we need to make the rules more burdensome. If you talk to a broker-dealer, especially small broker-dealers, or a small bank, you will hear them curse the AML rules. And in point of fact, there's a treaty before the Senate that would make the tax rules, which are close cousins to these rules, radically worse. And there's almost every year a call to make them worse. Norbert and my paper provide the first quantitative estimates of the cost and estimate that it's $4 to $8 billion a year just for the AML rules, not the tax rules. And that amounts to about $7 million per prosecution, which by itself would be an extravagant waste of social resources. But that's assuming that every one of those AML convictions is a standalone conviction instead of an add-on throwaway count and a conviction of a drug dealer on 45 other things, which of course is not the case. In fact, more often than not, AML counts are add-on convictions. It's quite likely that if you looked only at standalone AML convictions, these things cost $100 million per conviction, which is just a profligate waste of money. And yet the information is not there for us to be able to evaluate that. And these things are on automatic pilot, getting more burdensome every year. And they're one of the main contributors to the collapse in small banks and small broker-dealers. That's it.
Thank you, David. Brian, so my segue is not smooth anymore, but your chapter deals with something called fintech, and it's not necessarily just small businesses, but it is in a way a small business entrepreneurial capital issue at its core, wouldn't you say?
Yeah, well, I think I'd expanded beyond small business to just the ability of individuals to access services and control their own financial lives. And, the segue, I guess, is that the beauty of fintech is I get to be kind of sunny and optimistic. And that is that what we are seeing now is technology enabling new and innovative means of delivering services that people need. And that these new and innovative services have stood in the gap that is all too often created by overburdensome regulation. So community banks are disappearing, new means of lending step up. And that's great. The problem is that the regulatory environment that these things operate under is inapt, to put it politely. And the thing is, you mentioned earlier the notion that, we went through a phase of regulation where banks are special. Well, that era isn't gone. The banks remain special from a regulatory perspective. And a lot of these new fintech firms compete with banks on a particular aspect of the business of banking. So generally not deposits, generally you're talking about either lending or money transmission. A chartered bank has all types of regulatory advantages, mostly relating to the ability to conduct business at a national level under a relatively limited set of rules. Whereas the non-bank has to go and get chartered or licensed in every state and has to comply with every state's laws on things like interest rates, which of course for a bank, the beauty is you can export your home state interest rate law and make loans nationwide. What does that allow you to do? It allows you to achieve economies of scale. It allows you to offer a consistent product nationwide. It allows you to underwrite similar risks in two different states and charge them the same amount, rather than having to say, well, geez, I'm capped out somewhere or another. These non-bank lenders don't have that ability. So their choices are either go and get licensed in all 50 states plus the District of Columbia, and then comply with 51 different rule sets, or what a lot of them have been doing, particularly the ones who focus on personal loans, and therefore the usury laws tend to bite more, they tend to partner with a bank. Well, that's an interesting solution to a regulatory failure, but the problem is that even that is now under regulatory pressure. And today, apparently, the Southern District of New York, on a case on remand from the Second Circuit called Madden versus Midland Funding, has called into even deeper question the ability of this bank partnership model to work. The way the bank partnership model works, briefly, is that technically the bank makes the loan and then sells it to the non-bank lender who services it. That way, the loan is made under banking law, and you can take advantage of that export. It is a long-standing principle of lending that a loan that was okay when it was made cannot subsequently become usurious because the loan is sold. This decision turns that on its head. And so what we have seen in the Second Circuit is that borrowers, in particular borrowers with low credit scores, the more marginal borrowers who are poorly served by the current regime, the borrowers who have trouble getting a loan from a bank, who were turning to these new innovative lenders who have lower cost structures and can offer affordable loans, credit's being cut off for them, because no one wants to fund a loan that might turn out to be invalid later on. So in the name of quote unquote protecting people, we are leaving them to the mercy of whatever circumstance they had where they needed to go get that loan in the first place, right? Your car breaks down, you need to fix it or you're going to lose your job. You go get this loan and suddenly the state comes in, swats the loan out of your hand and says, aha, I protected you. That loan was too expensive. Meanwhile, you're looking at your car and you're like, what am I going to do now? And the state regulator is like, not my concern. I have to go protect someone else. So, all of that said, I am in the weird position, I guess, to argue for more federal regulation. Not, you promised me safe passage. Okay. So, now let's not set me on fire quite yet. What I'm arguing for is that because the nature of these transactions are interstate, right? The internet doesn't recognize state boundaries, and one of the beauties of modern technology is that you can achieve this national scale, which creates more liquid markets, it creates lower costs, it allows for people in credit-poor areas or states in the union to access credit-rich areas, that we should be treating these innovative companies on sort of a regulatory parity with more established firms. So the examples I use in my chapter are interest rate laws, where a bank can make a loan and it's totally legal. A non-bank makes the exact same loan and it's illegal. How does that make sense, right? It doesn't. A bank can get in the money transmission business and operate under its home state charter nationwide. Money transmitters need to get a license in every state they want to do business in. So David mentioned securities. I mean, the Reg A is a strong example of this, where it used to be, since they were subject to blue sky laws, you had to go and comply with every state you wanted to sell securities in, you had to comply with their blue sky laws. The Jobs Act changed that, and Reg A went from basically dead letter to something that's seeing some impact, it's seeing some growth. Companies are making these offers, companies are getting funded, people are getting hired because they're able to tap into a national market without burdensome state-by-state regulation. Now, the last part of the chapter is I'm not in favor of federalization on all the things. There are examples where, even though technically speaking, under current jurisprudence, the federal government could assert jurisdiction, they shouldn't. And the example I use is Rule 147, which is a safe harbor from federal securities laws for intrastate offerings. The concern was, if I use the internet for this offering, even if I'm only soliciting investors from my home state, do I run afoul of, do I trip into the federal laws? Because technically the internet is a means of interstate communication. And fortunately, the SEC, I mean, their new rules are not perfect, but fortunately the SEC has said that so long as you're only selling to residents of your state, we're going to step back. And that makes complete sense, because if you look at that transaction, the seller and the buyer are all in one state. The state is perfectly capable of regulating that. Everyone has access. Everyone has means of redress. That's all you need. But when you have a situation where you have to go state by state by state, not only is it inefficient, but some of the bigger states can distort the entire market, right? Because, if you're trying to sell a service, you're going to shoot for New York and California, and I'm sorry, Wyoming, we love you, but there just isn't enough money there. So the people in Wyoming are regulated by someone they have no say in. And you have a competitive equity issue, as I mentioned, because, a bank is offering the exact same product and doesn't have to deal with any of these problems. So that's the chapter lays out a framework for when regulators should look at something and be like, is federalization appropriate here or not? And hopefully, I'd say that Choice 2.0, at least according to the memo that's been floating around, contains a fix for Madden explicitly in it, which would be, I'm not going to endorse any legislation. My government affairs person left, but let it be known I do not endorse any legislation. But that's a problem that should be fixed one way or the other.
Thank you, Brian. No, and Brian's chapter is very well balanced and still limited government in scope, so it's okay.
It is. The net burden of government goes down.
That's why we let you here.
Okay. Even though I'm not wearing a tie?
Yes. Okay. That's okay too. That's okay too.
It is?
Well, technically, no.
Mercatus is a more libertarian than conservative institutions.
I'm not going to the tie part. The general theme, though, I think, it cuts across all of what we've done, and then we'll go to Thea. I think the financial industry it exists to essentially pool savings and pool capital and get those resources to the people who need them. That's the business that you're in if you're in that industry. And what we know, anybody who's paying attention to these things really closely, is that the regulatory agencies make doing that outside of the existing framework very difficult. And that's what all of these address to some extent. And everybody's familiar with the actual federal agencies. However, Thea's chapter goes a little bit beyond just one of the alphabet soup regulators that we all know and love, like the SEC, and talks about something called FINRA as well, which I would bet a lot of money on that most people outside of this audience here are not familiar with. And probably half of the current audience is not overly familiar with. Thea, what would you?
Sure. So one of the other issues that my chapter deals with, maybe more than some of the others, is questions of due process and the regulatory approach to financial services, especially in the wake of the financial crisis, where the reason that due process is important is because it protects people when they're not popular. And if there's one industry that has been unpopular since the crisis, it's the financial services industry. Unfairly, I would say, but certainly that has been the narrative that's been out there. And when we have that situation, we have to be very careful, especially when we're not dealing with the judiciary. The third branch of government has very explicit protections built in for due process to protect unpopular parties. And the regulators don't have that built into their structure. So my chapter deals with both the SEC and FINRA. I'll start with FINRA because in some ways it's the bigger problem. So this is known as a self-regulatory organization. It's actually this weird hybrid creature where it is, in some instances, private, and in some instances, functions as a government entity. It seems to function as private or public, depending upon whatever is best for it. So when it comes to things like setting salaries for its employees, it's private. When it comes to being able to protect its documents from things like, FOIA requests, private. But when it comes to actually having its rules be compulsory or membership in this organization compulsory, it's governmental. And it actually, what it is it's an association of broker-dealers. And, voluntary associations, great. There's all kinds of great things you can say about that. Self-regulation, that's fantastic. Historically, our securities exchanges have been self-regulatory, and that benefits the members because they come together and set standards for their own behavior so that they can improve their reputation and use membership in the organization as a selling point and as a competitive chit to say, look, we abide by these rules. We're a better, more reputable organization. It obviously benefits their clients because they're able to trust that the members are abiding by these rules. When you make membership compulsory, however, and then you make the rules of the organization legally binding on its members, that is government. I don't know what is more, what makes something government if it doesn't mean that you are by law bound by the rules that an organization creates. And so when you look at the powers that this organization has, so it can make rules for its members. It levies fees on its members in terms of, to keep up their membership. It also has punitive powers. It can't bring a criminal case, but it can bar you from the industry. It can impose fines. And it also refers cases to government agencies for prosecution. So to say that the authority that this organization wields over people is not governmental, I don't know what is more governmental than making rules for them, subjecting them to rules and levying fees, read taxes, on them. The best solution, I think, for this organization would be to just cut it off from the government, not make it mandatory. If you just didn't make it mandatory, a lot of these problems go away. And yes, you would not have all broker-dealers members, but as I said, the ones who wanted to become part of this organization and comply with its rules could use that. There's a business reason for them to join. It also would make it easier for competitor organizations to start up. If you look at the regulations that created this organization, they seem to contemplate more than one self-regulatory organization. So the law, the regulations say that broker-dealers have to be members of a self-regulatory organization as though there are many that they can choose from, when in fact there's just the one. And so what would be a much better system is to just make it totally non-governmental. Then if it wants to make its, that staff salary is $1 million a year, that's fine, because the members can say, well, I'm not paying the dues for that. I'm going to go to this other organization. And, then you get competition among the organizations to set rules that really are effective. Because the problem that you get is the sort of governmental problem where you have only one set of rules and there's no reason to evaluate them and see if they're actually doing what's intended. So if you have a rule that has the intention of protecting clients of broker-dealers, if the rule isn't doing what it's supposed to do, there's no way to try a different rule. So if you have, I mean, this is sort of the general big picture argument for competition versus government. You have another organization that creates a different set of rules, and you see which one's better. So that's, I mean, that overall is the problem with FINRA. The other section of my chapter deals with the SEC, which obviously is a governmental organization, but the issue there is their use of in-house judicial proceedings, essentially. In the SEC, and it's not alone in the federal government by any means, and I think it's problematic everywhere it exists. The SEC has the power to make rules, to enforce those rules, and to adjudicate the violation of the rules. Those are legislative, executive, and judiciary functions. And when you put those all under one person, that's a very big problem. There's a reason that we have separation of powers in our government. There's a reason that those are different articles of the Constitution. And by putting these all under one roof, you do exactly the opposite of what the founders were trying to do when they separated these branches in the Constitution. And just very briefly, you can see the problem if you have the same agency writing a rule, deciding that investigating your violation of it, and then deciding whether they were right that you violated it and imposing a fine on you. And arguably, this decision is appealable to the judiciary, but in practice, with how quickly defendants settle and other competing factors, it isn't really a full appeal to the judiciary. So my solution in that case is that when the SEC decides to bring a case, they can decide whether they're going to bring the case in-house in one of their own administrative courts or in a federal court. I think that everybody should have that choice. So if the SEC decides to bring an action against you, you get a choice too, whether you want to have that heard in federal court or if you want to go through the in-house process.
Thank you, Thea. And just to sort of put you on the spot, but anybody else can jump in. How much of a carryover do you think there is a real separation of powers issue with independent agencies? Do you think that that's something that needs to be addressed sooner rather than later, or it could wait, or?
I mean, so my pure solution is it's a problem. There is no independent agency in the Constitution. From a pragmatic standpoint, I just don't see them going away. And so I think that there are some changes that can be put in place to make their effect less problematic, including the one that's one of them. I think, that for my money, that one from the SEC is one of the biggest problems. I do think that the structure of the SEC overall is helpful. In that it's, many of these agencies, not all of them, are a 5-person commission with bipartisan representation. The idea is that there's some discussion among the different commissioners where, if the SEC has party line votes, it's a 3-2 vote over and over and over again, as there was recently, that attracts a lot of negative attention. So if we're going to have these agencies, I think that that's a better setup. But they are not directly accountable to the people, and it's just not constitutional.
No, that's fair. This argument comes up with CFPB as well, as you know, Dan. This idea that the CFPB is not really incredibly different or incredibly independent compared to all the other agencies, and we could have that debate later. But I just said, does anybody else want to jump on that one, or no?
Sure.
Brian?
So I'll jump on the CFPB.
Go ahead.
Well, so think about the CFPB, right? It is technically, as of now, an independent agency. The director can only be fired for cause. It has a solo director. It has an unimpeachable source of funding. So you've managed to cut off accountability from the executive because they can't affect who's running it. You've managed to cut off accountability from the legislature because they can't use the power of the purse. That strikes me as a bit much. And when, in a perfect world, it would be great if Congress legislated with such specificity that you didn't need these independent agencies to exercise discretion and basically write laws. In the world we live in, I agree that they're probably not going away. But if they're not going to go away, then there needs to be multiple avenues of accountability. And, I guess I should be thankful when they set up the CFPB, they would never admit this, but that was the left's embrace of public choice economics, right? It was the embrace of, oh, well, geez, regulators tend to get captured by interest. They operate in their own interest. We want to insulate them from that risk. So we're going to create this incredibly insulated agency. I don't think it worked out the way it was intended, but if we're going to have these independent agencies, we need to have accountability. We need to have there needs to be means of democratic accountability and not just, well, we've nominated you, we've confirmed you to be king for the next 5 years. Go forth.
I'm not sure what you meant by it didn't turn out the way they intended, because I think it turned out exactly as they intended.
You're more cynical than I am.
Well, okay, just
and
based
until-
on what Warren was after,
I mean, until we have a Trump-appointed director,
Right.
which we will have by the middle of next year, if not sooner, so.
Yeah, I mean,
Trump-appointed king.
well, I mean, that's the thing, right? Is eventually, like, there's no permanent political ascendancy. So eventually, the tool you create will be wielded by your enemy. And
Yeah.
the commission has the benefit of being multi-partisan, right? It doesn't necessarily need to be even bipartisan. A libertarian could slip on there. But at least then you have.
Do you have any names there?
But I would argue, even if Trump, it gets rid of Cordray somehow and appoints his own director, that we should still go after it just as strongly as we would have had Cordray remained in the job. I mean,
I don't
it's-
disagree.
Absolutely.
Yeah, it's the nature of the organization, not the person who's running it, that's the problem.
Yeah.
I just suspect that the supporters of the organization would be less happy with its activities
certainly.
under Trump-appointed director.
You could put a Trump director there, and then they'll all be on board with getting rid of it. Ideally.
I think that is a theme that runs through all of these agencies, though. I think, and the commission does diffuse that, but the devil's advocate argument against CFPB is that, well, you have something like the comptroller, and, you have one director, you have one comptroller,
Yeah, but-
and they charge fees. Oh, I don't agree with it. I'm just saying, that's the argument, that it's not so bad.
Though, I mean, the difference, like, if they want to turn the CFPB, if they want to model the CFPB after the comptroller, they're going to make the director removable at will. They're going to set the CFPB's funding based upon its regulated entities, giving them some sort of feedback. If we're too harsh, we're going to kill the market that we use to sustain us. And we're going to create a parallel regulator, a la the FDIC and the state chartered banking system, that allows the regulated to have at least some control. And there is a debate about how much regulatory competition is created by the dual banking system. But there's at least an off-ramp to say, wow, OCC, I don't like what you're doing. I'm going to go get a state charter and be regulated by the Fed or the FDIC. The CFPB has such plenary authority that, it wouldn't, that model, I don't think that model, not that you were making the argument yourself, but I don't think what about the OCC model really holds. But, look, if you want to take away that source of Fed funding and make the director removable at will, that's a step in the right direction.
Yeah. No, it always struck me as curious to set it up that way, because it's going to come back against you at some point anyway, but.
Just one last note, those of us who would like to see changes in the CFPB may have welcomed the opinion in the recent PHH case, but we have to be really careful, because I'm not sure that the ruling in that case would stand up otherwise to our principles in terms of a clear reading of law. So that's going to be appealed, and we'll see what the ultimate outcome will be. But but I would encourage everyone to be very cautious about jumping into support of a ruling by virtue of what its result was as opposed to how it was reached.
Do you mean the solution? I mean, the remedy, or do you mean the?
No, the
real-
finding, the basis of the ruling. That is that, I mean, they basically, decided that because it's different than others, that's the basis of their constitutional finding. I'm not sure that that's as solid as they've made it sound. Anyway, we can move on.
Okay, all right. Well, so I'll sort of say one more thing about the book in general, and then we'll have some time if we want to do some Q&A stuff, or if anybody else on the panel has anything that they want to add in. What I wanted to say about the book is there's sort of the way it's structured. We start off with banking, we move into securities. We do spend a lot of time on specific federal policies on the federal backing. We do a lot of the housing finance reform. We actually have 2 specific housing finance reform chapters, I think, because it's broad enough. We work to more of these, I would call them stricter legal issues. I don't know, maybe the lawyers on the panel don't like that characterization, but that's how I view them. And then what we end up with is sort of just a funneling into a way forward. And one of those, I think, actually, I was joking with Brian about this before, but I really do think one of those is his chapter, because you have to look at this from an entrepreneurial aspect. What are the new ways that we can get capital to the places that it's needed and most valued? And that's an important part of that. And then the other chapter is one that I co-wrote with Jerry Dwyer, who I've co-written some other pieces with in other places. And the idea takes off of the off-ramp that you'll see in the Financial Choice Act, versions 1 and 2. And it expands on this capital election, and it expands on it both numerically and conceptually. And there's an enormous list, I think it's an enormous list of regulations, and it specifies exactly why you should be getting rid of these regulations for a firm that is absorbing its own losses, which is the whole idea behind the capital election. So it calls for a higher number, a flatter version. Not that there's anything wrong in particular with any of the other proposals out there, but this is another way of looking at it, I think a more expansive way of looking at it, and it's a more flexible way of looking at it. So it's not necessarily a fintech charter, but a fintech firm that is a bank or like a bank could use that charter to expand its operations more easily. It would be more well-defined in the industry, and sort of out of that safety net and overbearing regulatory framework that we already have. So I would encourage people to read the whole book, of course, but look at that last section in particular as a way of just sort of going to the next step. We do have a couple of microphones out and about, and if we do have any questions from the audience, we could do that. We do have one question. We do.
Thank you. Lev Bagramian with Better Markets. Thaya, I look forward to reading your article. Just a quick question. Can you give us an example of maybe other industries where they're allowed to pick their own regulator? Like, are drug companies allowed to select a kind of regulator that would be cheaper or more effective, as you said, or, chemical producers or weapons producers? Any other industry you could think of that should be allowed to select their own regulator? Thanks.
I mean, I guess the issue is that this is set up as a self-regulatory organization. So, I mean, I think that ranking solutions, the best solution in my mind would be for them to have a self-regulatory organization that has no government backing. The next one would be to just make it government, to just make it a government agency. And then the last one would be what we have right now. So, I mean, I think that I can't think of another industry. I might turn the question back and say, I can't think of another industry that has this weird hybrid that has the worst of both worlds. And so I might argue that self-regulatory agents, we should have self-regulatory organizations in more industries, but I don't think that we should have any like we have in FINRA.
If I could just pop in 1 second. The thing is, the difference, one of the differences there is the securities industry has the SEC, right? So they don't get to choose their regulator. Their regulator is the SEC. There is this self-regulatory organization sub-regulator entity, which, as Leah points out, is kind of weird and fairly unique. The other thing I would point to is I'll give you one, banking. Because I can choose to be a nationally chartered bank and get an OCC charter, or a state chartered bank and deal with the state and the FDIC or the Fed, right? So there is at least some elements of choice there. Now, whether or not the dual banking system is a good idea, and if we had it all to do over again, we would do it the same way, I'll leave that to others to describe. But there is an example where at least there is some choice of regulator.
Does the AMA, AMA sets its licensing standards, right, for the medical profession?
Yeah.
I don't know how that, if it,
I mean, look, I'm a lawyer. I'm not sure about the bars in the different states
Yeah.
either. I mean, that's kind of a racket on its own, but we're just dealing with, the securities industry right now.
When the federal government's involved, of course, the tendency is for there to be one regulatory agency. But when you think about regulation more broadly, including private regulation, then it's easy enough to come up with examples. For example, if you want to list a security, you can do it through an organized exchange, you can do it over the counter. These are examples where you have different regulatory frameworks that are not necessarily government regulatory frameworks, and you can choose which one you want to deal with. And it seems to work pretty well.
I think that what's important is that it's not just the regulated who get to pick in that case, it's the people who are the clients who get to pick. Whereas in existing, if FINRA has a rule that's terrible, the clients are just subject to that rule too. If there's a better way of providing, investor protection, we don't know because we don't have a different organization creating those kinds of competing rules.
Anybody else? Are we going to get away with just one, really? Or one more in the back?
How's it going? My name is Patrick Michaels. I'm a public policy fellow from Senator Isaacson's office. My question is for you, Thaya. So we talked about the FINRA. What would be a remedy, or how do you think you could allow for more competition, or would you just go away with the FINRA and just stick with SEC? Is that what you were purporting?
Yeah, I mean, I think that the fact that FINRA has this government backing where it has to be registered with the SEC. It's the only SRO that exists. It's this meshing of public and private that creates the problem. So I think that if you either severed that bond or then had it absorbed into it, those are the solutions. And once it's severed, you have more options for creating other organizations. Right now, the barriers to entry are so high that it's really impossible for any other entity to come in and create a competing organization. So I think that would be the solution.
I add one thing to that, and it's a similar problem. I mean, I think, I agree. I mean, I think you should pick one model, and this combination of a private public is a regulator type agent is a total disaster. We did the same sort of thing almost in Title VII of Dodd-Frank, and I know this panel is not necessarily about Dodd-Frank, but Title VII requires swap dealers and swap participants, et cetera, to register with a National Futures Association, or with a registered futures association, of which there's only one. The National Futures Association, of which it costs between $15,000 and $1 million to join. That is a disaster waiting to happen, and nobody stops to ask why. These are not products like apples or radios or toasters. These are contracts. And the notion that you're going to have a regulator come in and bless these contracts as safe for everybody is dangerous. And we've proven that so many times. It's hard to even imagine that we're doing it again, but we're going right down the same road again. And this is just not the way that we should be going at all.
It bears mentioning, by the way, that the Fed itself may qualify as the prototype gigantic semi-private public monopoly regulator, and that the rest of these, including the Consumer Finance Protection Bureau, well, that's just a Fed off-balance sheet operation, isn't it? Mm-hmm. It's just a little spin-off. They fund it.
Mm-hmm.
It is. And we had, so one of our chapters, we've also got a reference to an earlier version of Dodd-Frank. Chris Dodd had a draft, he actually drafted the legislation to move the Fed's regulatory authority out of the Fed.
To where?
Well, that's the part that I didn't like, but they're going to create one massive financial regulator. But I mean, I think that if you look at that as a model of, say, creating, just for example, one capital market regulator, one banking regulator, that would be an improvement over what we have. And there's actually, not that I'm endorsing legislation either, even though I'm wearing a tie. There is a model for that already out there. And we know where a lot of the traps are. We know that if you try to merge the CFTC and the SEC, you cause a nightmare, especially on the Ag Committee. But then, you know, if you remain cognizant of that, then you can get around it maybe by using, I don't know, the president. You know, if you have an the administration that's behind something like that, then there are ways to get around that. So I won't go down that whole road, but I mean, those are the kinds of things that we should be looking at too, and that's in one of the chapters as well.
Well, one big regulator is better than a bunch of little ones, but only in the same sense that a big cancerous tumor is better than cancer that's metastasized.
You know exactly where it is, and what
You
to do
might
with
be
it.
able to get rid of it.
Do we have anybody else? Anyone else? No? Okay. Well, thank you all very much for coming and staying, even after French Hill left. And thank you guys very much.
You know.